Hello everyone and welcome to BFW 2401. This is week 3 and we are talking about loan sales and securitization. Now in loan sales and securitization, it's a new financing mode in finance, and in banking now we have two modes. One is generate and hold, and the other type is generate and distribute. Now, to recap on these 2 points, generate and keep is when we issue the loan and we keep it till maturity. But now we have a new model which is generate and distribute, which means we will issue the loans and we can sell them anytime during the life of the loan. This is why securitization and loan sales come to the picture. Now, in loan sales and securitization, we have two types for loan sales, and we have few vehicles for securitization. Let me start a little bit with you with loan sales. Now, loan sales, if you can look in this balance sheet, for example, we have a balance sheet before and after the securitization. I have around 90 of loans, and with those 90 loans, I can sell 20 of them, then I will be left by 70. If you look at the balance sheet before and after, it's clear that we have 90, 20 has been decreased from the loans, and with the cash is increased by 25. This is how the structure of the balance sheet can be changed when we make the loan sales. Now let me just preview on the lending objective of what we are doing. Actually, we want to see why we want to explain a little bit about the loan sales. We want to see their types. We want to see and talk a little bit how we can use them to manage our interest rate risk. And we want to explore a little bit about the loan sales and securitization vehicles, which means in terms of their types. Now, the most important thing in loan sales and securitization is actually managing the interest rate risk. And when I say interest rate risk, let me take you back to the repricing model. In the repricing model, we have to calculate the gap. And when we calculate the gap, we have to multiply the gap by the changes in the interest rate, whether the interest rate is going up, down, or stable. Now, if you look at this slide, for example, we have 15, which is assets, and 10, which is liabilities, which you call it risk-sensitive asset minus the risk-sensitive liability. We have around 5. Now, if we have a positive gap in this case and the interest rate is increasing, then in this case, the impact on the net interest income will be positive. And therefore, if I know that the interest rate is going to go up, it's time for me to buy loans. If I know the interest rate is going down, then I need actually a negative gap, which means I have to decrease my assets. So I have a negative gap, which means the difference between the risk-sensitive asset and risk-sensitive liabilities will be minus. And if there is a decrease in the interest rate, then I will have a plus impact on the net interest income. So this is the whole story of managing the interest rate risk. Now you can sell the loans as loan sales, which can be in the local arena, or you can make what we call securitization, which is another backing of those loans, making them bonds and sell them anywhere inside the country or outside the country. Having said that, if we know the whole issue of loan sales and securitization, let me just concentrate a little bit in the loan sales now. There is some trends, and actually it was very active, especially during the financial crisis, in fact, during the financial crisis, loan sales and securitization specifically, was blamed for a big part of the problem happened during the financial crisis, since they were backing all these toxic assets through securitization and sell it. Well, and then when the collapse happened because some of those bad loans. Now, this is maybe so many trends over there, but let me stop here, which is the trend in the US and the European Union between 2005 and up 2020. As you can see, in the US, there has been growth, a little bit drop during the financial crisis, but it comes back up and picking up now in 2020. The same thing applies to the European Union, but there has been a decrease actually during the 2019 and 2020. Now let me go to loan sales and securitization. Loan sale types, we have two types. We have someone called participation and the other one called assignment. Now, to connect these two terms, participation means about the credit risk. I say the loan, the buyer will take the loan, and if there is a credit risk, which means the borrower didn't pay, then the buyer of this loan has to come back to me, which means me as a bank, as a seller of this loan, I still take the credit risk. Assignment is when I sell the loan and the buyer will not come back to me anymore. And therefore, the common practice now in banking is actually sale with assignment. Now, let me just add two terms. When you want to connect assignment, please connect it with the term selling without recourse. When we want to connect assignment, then a participation, then in this case, participation means selling with recourse. This recourse means the buyer will be responsible about the credit risk or not responsible about the credit risk in the assignment arrangements. Now, there are so many reasons actually other than managing the interest rate risk when you do loan sales. We can manage our credit risk management. Look, when you sell a loan, actually you sell a loan with all its problems. You have a credit risk, it's gone. You have a market risk, it's gone. You have a liquidity risk, it's gone. All those issues, you throw it out of the balance sheet with all its problems. But when we talk about securitization in terms of the risk management and banking, we are using it for managing the interest rate risk through managing the gap, as I explained earlier. But you can talk about the credit risk because the credit risk will be decreased. We can talk about the reserve requirements because if you look at Bank Niagara, for example, in Malaysia, they are taking now 2%, which means out of each dollar you receive, you have 2% that has to be deposited in the in Bank Niagara. And that will be like a free tax. There is no interest in that. There is no return in that. And therefore, when we are talking about decreasing that reserve, if I can sell the loans and bring the money back to the depositors, that means my deposits is less and my reserve is less. I can have fee income, which is a huge income now, which means I can have issue too many loans, collect the fee and sell it the other day. Capital cost is also related because when I do capital cost means, as you can see, capital is a percentage of the assets. If I decrease the assets, I can decrease the capital. And therefore, my obligation to hold a big capital in the bank can be decreased when I do loan sales. And lastly, or last but not least, you can talk about the liquidity risk. Of course, when you sell loans, you bring a lot of cash to the bank. You are not stuck with any liquidity stress in the future. That's all about it. I just give an example here. When we come to the technicality of calculating, because loan sales is like buying and selling any other asset. Think about selling or buying a car. The most important thing you want to talk about it is the price. And we want to price a loan. When we price the loan, we just discount the future cash flows. Future cash flows of what? Of the payments or the interest of the loan, and the discount of the principal at the end of the life of the loan. So in this example, for example, just to take like this example, we have a 10 million ringgit loan that gave 8%. Now with this 8%, we will have around 800,000 as interest for 3 years. We have to discount those 800 payments for 3 years, which means we have to use annuity, and we have discount also the principal and bring it to time 0. In this case, I discounted both the payments of the interest and the principal, and we get 98093 for the price of this loan under different discount rates, either 8.5% or 8.75%. That's it for part 1. Thank you very much, and I will see you in part 2.